Let us show you the power reports. Perhaps this is a much bigger reason why you should be doing the update, because this is management accounting. Management accounting is information meant for the management to update and keep themselves informed so that they can make good business decisions. Sad to say, accounting information by and large is not used for this manner. It is treated more like statutory accounts rather than management accounts. People in smaller companies do not usually have full-time accountants. They don't have somebody in-house to keep their accounts, and they depend on an external accountant or a tax consultant to just hammer together a set of accounts for tax purpose of submission to KARrpt once a year. This makes accounting very costly. You are spending time, money, and resources making accounts for the government, for the authorities, and not for yourself. And is that satisfactory? I don't think so. Now, unless you have a full-time accountant that can massage the information given to you by an ordinary accounting system, you are not going to get very much out of it. The reason being, you need a fair amount of skill in financial management to be able to take some information from the P&L and to take some information from the balance sheet and to juggle this information and come out with meaningful information that will assist you and facilitate prudent financial management and informed decision-making. All this is not possible if you are just using an ordinary accounting system. This is why it is so important to get the enhanced version, which even in the absence of in-house expertise, can give you reports beyond the usual P&L and balance sheet, such as the KARrpt. No standard accounting system out there has got this feature. KAR stands for Key Accounting Ratio Report. Let's take a quick peek at the liquidity status report. What do you see? Well, probably three numbers that says current assets, current liabilities, and liquidity ratio. Do you make sense of this? Do you know what is liquidity ratio? And do you know why it is important? If you don't, it is perfectly normal. You are not alone in this, because financial management is an area that is seriously neglected by entrepreneurs who do not have the basic training in financial management. They simply cannot see this, which is why even very successful companies went bust, even though the business is good but financial management is poor. They work themselves to a position where they don't have enough working capital. Cash is king in business. You can run into serious problems the moment you run out of cash and working capital. So this liquidity ratio means your current assets exceed your current liability by over 2 times. To be exact, 2.38 times. Does it make sense to you? This is the ratio of current assets and current liabilities. But what are current assets? What are current liabilities? If you don't know the answer, you better start to know the meaning of these two terms. Current assets are liquid assets, which are assets that are already in cash or convertible to cash within a very short time. It takes the form of debtors, customers who owe you money, which is a paper asset that is convertible to cash. It can also be in the form of stocks convertible to cash. Next, we talk about current liabilities, which by now you should have guessed that it is something that you are due to make payment for within 12 months. So, on one hand, you have got your current assets. On the other hand, you have got your current liabilities. In this case, your current assets are more than your current liabilities. It means that you are very well placed. You have good working capital. Now, what is working capital? I have already given you a rough idea. All you need to do is click on this working capital report to get a much clearer picture. In this case, you can see that you have got trade debtors, customers owing you money about $71,000, some petty cash of $800, bank account of $329,000, and cash sales float. Now, here you have money owing to the director, $132,000, and intercompany account, provision for taxation, goods and services tax, paid on the total basis. So if you add up all your current liabilities, it gives you this amount of $169,000. Subtract that from the $401,000, which is your current assets. Then you have working capital of $232,000. So this working capital now gives you a clearer picture than just the liquidity ratio. So do you agree that such ratio and reports are important to every business? So that they do not run their business day-to-day blindly and precariously without understanding what is working capital. No other accounting program can give you reports like this, which is why we urge you to make your upgrade now. Put yourself in better control. Empower your managers to make more informed decisions with TradPack Enhanced IAF version. Now let's move on to what the KAR report, or Key Accounting Ratio report, as mentioned earlier. It's a very comprehensive report that will give you a very good feel of your business. So let's put in the period starting from the 1st of November 2014 to the current date. Now this report will tell you for the period specified your total sales turnover, your gross margin, and your gross margin percentage. Now, would you agree this is very useful information? Then it goes on to tell you about your sales turnover at daily monthly intervals. You can see on the average you are doing $143,000 monthly and $4,779 daily. This is really useful information that will allow you to make informed decisions. But that is not all. The KAR report, or Key Accounting Ratio report, is something you will find amiss in any ordinary accounting system. This is alien to smaller enterprises that do not have a full-time accountant to derive these figures from the P&L and the balance sheet for them. And even if you do have a full-time accountant, often you will find that accountants don't even have the time to do up this report for you manually.